Hi and welcome to Swissquote's Daily Market Talk. It's Friday, September 19th. The Fed decision to start cutting the interest rates this week sent global markets higher, but the Bank of Japan just dampened the mood today by announcing its plans to sell ETFs next year. So what are the global implications of that decision? What are the risks for Japanese and global financial markets? And what else is going on with Intel and Nvidia? So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the market's final verdict for US indices was clear. The S&P 500, Nasdaq, and Dow Jones all hit all-time high levels yesterday, a day after the Fed started cutting its interest rates for an economy that it raised its growth forecast. And the US small cap index jumped 2.5%, while the Stoxx 600 index and FTSE 100 rebounded yesterday as well, despite both the European Central Bank and the Bank of England having delivered no interest rate cuts at their latest monetary policy meetings and are also expected to deliver no more rate cuts for the rest of the year. So I will come to yesterday's Bank of England decision later, but first, while the stock markets were up for fresh records at yesterday's trading session, a big slump in weekly jobless claims in the US raised some eyebrows among the bond traders there about the health of the US jobs market. So the US two-year yield rebounded to 3.58% yesterday on expectation that maybe things are not going that bad. But the weekly job numbers in the US tend to be volatile for multiple reasons, so I don't necessarily think that a weekly figure changes the narrative of the moment of weakening US jobs market. So I will be more concerned and more scared actually to see inflation pick up in the US as expected rather than US jobs market return to healthy figures all of a sudden. So all in all, the US and world financial markets popped the champagne yesterday after the Fed's decision to start cutting the interest rates. But the Japanese equities are feeling hungover this morning, mind you, after the Bank of Japan there maintained its interest rates unchanged, which is a good thing, mind you, because the Bank of Japan's next move is actually expected to be a rate hike and not a rate cut. But the BOJ also announced that they will start selling about 330 billion yen worth of ETFs per year. And considering that the BOJ has actually become a big holder of assets, especially domestic assets in Japan, the announcement that they will start selling these holdings did little good to investor sentiment into the weekend in Japan. So the Nikkei index is down by more than 2% at the time I'm talking here this morning. We are just before the BOJ's press conference. And the risk now is that this shift reverberates beyond Japan because tighter BOJ policy could counterweigh the Fed-driven optimism in global financial markets and add pressure to richly valued US technology names, for example, and Europe's luxury and cyclical exporters as well that are heavily exposed to Asian demand. And on the fixed income side of the game, reduced Japanese demand for overseas bonds that they are also big holders of could eventually push yields, especially the long maturity yields in developed markets higher, especially in the US and Europe here, while currency moves in the yen may actually worsen the matters if the Japanese yen finds a firmer footing and the Bank of Japan hikes interest rates in the continuation of their normalization efforts that could eventually trigger a potential reverse carry trade and weigh on global risk sentiment. So in short, what looks like a step toward long-term normalization in the Bank of Japanese monetary policy, risk feeding near-term risk of sentiment globally, and the Japanese 10-year bond yield this morning is up following the BOJ decision, mind you, while the US 10-year yield probably hit a bottom near the 4% level this week. Now, sentiment across the futures markets are flat this morning. FedEx up by 6% in the after hours trading on strong results, but we could see some profit taking at the end of a central bank decision rich week where, I summarize, The Federal Reserve started cutting its interest rates and announced more rates to come by the end of this year. But we also saw a great disparity among the Fed members on the dot plot about what they are going to do next, especially next year. Then the Bank of Canada cut its own interest rates by 25 basis points this week, while the Bank of England and Bank of Japan decided to keep their policies unchanged. So speaking of Bank of England, real quick, the Bank of England maintained its own rates unchanged at yesterday's monetary policy decision, but decided in some kind of a dovish move to reduce the size of the QT, so they will be selling £70 billion worth of assets over the course of next year instead of £100 billion assets, and sell more short-term gilts than longer-term ones in order to cool down the pressure that we see on long maturity yields today, that also put a heavy pressure on pensions and insurers and increase the government's borrowing costs as well. So we will see whether that will help the UK government gain some fiscal headroom into, well, the budget announcement of the next weeks. But the 10-year gilt yield in the UK was higher into the BOE decision and closed the session higher than where it started after the decision. In summary, risk appetite seems intact, but it is fragile. The long maturity yields of developed markets remain under pressure. US technology valuations remain rich, and political and geopolitical tensions across the US, Europe, the UK, and Japan remain on the headlines of the global financial news. And today, Donald Trump and Xi Jinping will speak on many issues, including trade and TikTok, while we could see a further extension of the trade truce between the two nations. The longer the negotiations go, the more aggressive measures the Chinese are taking over in China to reduce especially their technology dependence on the US. And that's a big deal because they no longer want local companies to buy Nvidia chips, remember? And they instructed just this week Alibaba and ByteDance not to buy these chips from Nvidia, while the US is brokering mega deals among its own US-based companies and US companies to bring manufacturing back to America and also reduce their own dependency on foreign nations. So, chip news are getting more political by the day. I think we could say that comfortably, because yesterday Nvidia announced to have agreed to invest $5 billion in Intel for about a 4% stake and to collaborate on developing new chips for both PCs and data centers, pairing Nvidia's GPU and AI expertise with Intel's CPU ecosystem. So this deal could be a major vote of confidence in Intel's turnaround, it is said, or it is simply a major political gain, a political win for Trump's administration that actually wants to revive an ex-national champion, which is Intel, to bring chip manufacturing back to the United States. Nvidia, on the other hand, could gain more control over the integration of CPUs and GPUs in AI infrastructure, but more importantly for the company, they will have stronger political attachment to the US government. So Nvidia shares actually were up by around 3.5% yesterday, while Intel jumped 23% and will likely continue to be shot higher time to time by similar government-related news. Now note that the Nvidia CEO Jensen Huang still said that the discussions about this deal were going on for a year and was not necessarily related to the latest developments, but the way Nvidia is navigating the political environment right now is both interesting but also scary. Now, for other chip makers, Nvidia Intel deal of yesterday raises pressure for AMD, for example, that is so far not part of such strategically important chip alliances in the United States involving the US government. While in China, well, the Chinese SMIC is consolidating gains near its all-time high levels this Friday. It's also helped by news that Huawei, that's not publicly traded unfortunately, also announced this week new AI chips and supercomputers that will roll out from 2026 to 2028, aiming to compete directly with Nvidia by using its own advanced memory and large-scale computing system. So that's going to put more pressure on Nvidia, even more so as the Chinese government will push the local companies to buy Chinese. So this week ends with heating chip wars, strong technology demand, especially in Asia, supported by softer Fed policy, but a lot of looming questions and uncertainties regarding the rich US tech valuations, ongoing political risk, and multi-year high long maturity yields in developed markets. So we will see how this risk appetite holds and how long, but this is all for this week. I'm İpek Özkardışkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.